Hey guys, Taylor with GammaEdge here coming at you with a post-market recap for March 27th, 2025. After linear dam day that we saw yesterday, today can be characterized more as a choppy day below the bottom of our transition zone. Did offer great two-way action. But before we get into that, let's set the stage with what our pre-market prep was. So pre-market prep always starts with our market trend model. This is a simple way for us to understand the trend and momentum in market, and it's based off the tick index, which is a direct measurement of buying and selling. The market upticks, tick moves higher. If the market is down ticking, then it moves lower. What we do is we take the raw daily tick and we create a time series out of it to what we call the cumulative tick, which is this bolded white line down here. We do this so we can understand day-over-day trends. So this is useful both on an intraday and also a swing time frame period. Last night we talked about how market trend model was brutal if you're a bull yesterday. Reason for that is we had linear down, waterfall down really, which just means that there was sustained selling all session. Additionally, if we look at the filter tick, which this measures plus or minus 1,000 tick readings, and that's an industry standard for generally accepted large buying and selling. So here again, not only did we see large waterfall selling all session, but it was large in nature and magnitude. Further, market breadth was awful yesterday as well, with 52-week nodes significantly outpacing 52-week new highs. Backing up to before the collapse, just want to show you guys what an ideal picture from a bullish point of view looks like structure-wise. Here we have the cumulative tick trending higher above what we call the railroad tracks, which is just a short-term moving average ribbon. This is a consistent signature that we see when markets make a trendy move higher. And so before getting too bullish on the market again, we need to see this type of signature form again. And again, just to recap, this is what last night looked like or at the open today, and clearly that is nothing like what we just discussed here. After going through the market trend model to understand where the trend and momentum in the market is, we then go and we look at the SPX options complex. The reason we do this is because by definition, options market are forward-looking, so we can understand what speculators' expectations are going forward. Additionally, we use SPX because this is one of the most liquid, deep, and speculated on markets in the United States. So this gives us a great overall picture of how the crowd is positioned. Within the context of SPX, we break it up in between SPXA and SPXP. SPXP are your monthly and your quarterly expirations. We like to think about it that this is more of where the longer term institutional type capital is positioning, as opposed to the SPXP, which is your 0DT and your weekly expirations. And that is much more where short-term speculation takes place and those contracts turn over a lot quicker. So SPXA, think of that as your cruise ship, and SPXP as your cigarette boat. So within the context of SPXA, coming into the day, the structure was brutal. By that we say brutal because it was put dominated above the spot price as opposed to call dominated. If you're not familiar with GammaEdge, we think about the markets as a battle between call and put speculators, specifically as it relates to out of money speculation. And so it's a sine wave, right? That battle between call and put speculators, and we want to understand where on the sine wave we are at. Just as a reference point for you so you can see what a healthy structure looked like. Here, this is SPXP, and here you can see that this complex is showing a ton of green, and by a ton of green, we mean that call speculators are dominated above the spot price. So again, take a mental picture of this, and now compare it back to this structure. They are nothing alike. So, okay, step one, market trend model, that deteriorated, that is trending lower. Step two, SPXA, the cruise ship, that is put dominated as well. So if you're a bull, no reason to be bullish or participating right now. Next, we go to SPXP. We look at all expirations. Again, this is a cigarette boat where the short-term speculators like to play. Once again, this structure is put dominated. So again, market trend model lower, the cruise ship is put dominated, cigarette boat is put dominated. Now we understand the trend and the structure of the market and sentiment. So then next what we do is we understand where those key transition zones are in the structure. And we do that specifically through what we call our transition zones. Those transition zones, just think of that as those are shifting points to where speculation shifts from favoring the put speculators to favoring the call speculators and vice versa. So this purple box here is what we call the DEX transition zone, is based off delta. And so simply put, in between this box is what we see as a transition zone because there is congestion between call and put speculators here. To the downside, this is where it's more of a put favorable structure, and to the upside is where it's more of a call favorable structure. And so yesterday we settled below today's pre-market transition zone, and we clearly opened below the pre-market transition zone. So until we're able to get above the top of this transition zone, it really does not make sense to be looking for longer term swing trades. Now that we have that established, we can then get into 0DT, which again, 0DT is kind of its own beast. On an intraday basis, there certainly can be a counter trend rally, something like that. So that's why it's important to dissect 0DT as well, especially if you are trading specifically 0DT, then you definitely want to be analyzing this structure. But the methodology is the same, right? Our process is fractal in nature, so what can be applied on one time frame can be applied on another time frame, and what can be applied on one instrument can be applied to another instrument, assuming all instruments it's being applied to have a liquid and deep options market. So coming into the day, we were an overall put dominated regime. You can see above spot price in the money puts were dominant, below spot price in the money calls were dominant. That's a pretty standard structure. However, that's where it's important to understand that distribution of call and put speculation, and we do that again through the transition zones. Today, the key delta and gamma transition zone, there was confluence there at 57.35, 57.40. Again, above 57.40, this is where we would expect calls to start to become more influential on the structure. And on an intraday trading basis, we would be looking higher. Because remember, in the context of the overall structure, things were quite bearish. And then so long as we remain below 57.35, we were looking more towards the downside. And again, further analyzing structure, we also have another transition zone that supersedes the DEX and the GEX transition zone, and we've referred to that as the drunken sailor zone. The concept behind the drunken sailor zone is understanding the distribution of calls and puts throughout the chain. There are still major goalposts that need to be overtaken before the options and the moneyness of those options can play a significant role. And so while we remain in these transition zone, that is where volume is going to be, intraday volume is going to drive price action more than market maker, dealer, and option moneyness dynamics. And so pre-market, we were saying that those bounds were 57.45 to the upside and 57.30 to the downside. Those also corresponded with the key major gamma levels. However, we also noted that there was an air pocket right here if we were to get a downside move, which obviously we know we gapped open to 5,700, right? And so there's a secondary DEX transition zone all the way down to 57.90. So again, what that means is as we were getting down to 57.90, we would want to see intraday volume activity, especially on the put side, trend lower like we saw yesterday, which means that out of money put speculators are continuing to speculate lower. Because as we will get to in a minute, we did gap down pretty far into the structure, pretty extended from the transition zone itself. So the way that you can think about it there is from yesterday to today, a lot of those put holders started to become in the money. And being the 0DT contract, they're now sitting on a significant amount of unrealized gains because they've captured a significant amount of that out of the money risk for when they put the trade on. So the risk there is that they monetize those positions. So that's why it's critical to see that intraday volume continue to push lower. And just a news flash, we did not get that. So now that we have that established, let's go back to the price chart and look what price action did today. So again, here, this is SPX. This is 5-minute chart. We have the drunken sailor range drawn out here in the teal box. I didn't draw that. I didn't draw the DEX transition zone just because it was, just 5 strike different between the top side and bottom of the drunken sailor range. So again, we gapped significantly lower, a little bit of a push, but remember we were significant away from the drunken sailor range. So frankly, shorting in that far in the hole is just not attractive because remember, think about it as the rubber band is significantly stretched from the drunken sailor range. So what we see generally there is there's some kind of just mean reverting move. It could be monetization of those positions or whatever, but that's exactly what we got. We got a reversion move back to the I guess kind of balancing the structure back to the bottom of the drunken sailor range. And we did not see any, intraday volume push lower. Then again, from the top of the drunken sailor range, we did see a push down to roughly, 57.90, which was the bottom of that secondary DEX transition range. But again, we didn't see a push lower with intraday volume, which I'll get to in a second. that gave us great confidence that we could see a waterfall move lower like we did yesterday. And again, for those folks that are into technicals as well, that corresponded with the opening print. And also we had a fairly flat VWAP on the session, which, kind of does promote that kind of choppy price action. So I've talked about it a lot. Here is our visual, what I mean when I'm talking about intraday price action. So what this is this is a representation of SPX 0DT call and put volume throughout the session today. And what we do is we find the midpoints of the volume distribution on a 5-minute basis, and we plot those throughout the session. We connect the dots for you so we can just kind of form visuals and trends. And this helps us understand what the behavior of the call and put speculators in the 0DT contract are doing. Reason this is important, right, is because I think I saw a stat today on Twitter, like 60% of options volume is contained within the 0DT complex. So this is going to have a significant impact on that intraday price movement. And again, if you're not familiar with what a centroid is, that's just on a 5-minute basis, we aggregate the data, we find where that midpoint is, and we plot it here both for the call and the put side. And at any given point in the day, what we do is we look back and we say, okay, this is what the trend of the call distribution is, from 9:30 to noon. And all things equal, if the sentiment and the behavior of those call speculators is going to remain the same way until the close, we can kind of project out through our lines of best fit where the projected price is. We do that both for the call side and for the put side. And so at the end of the session, it's 9:30 right now Eastern Standard Time. We can look back at our end of day clip, and it's clearly a choppy signature. And by choppy, I mean the call speculation for the day was generally lower, and the put speculation for the day was generally higher. One important thing to note was right off the open, we got that push lower. However, call put volume was trending higher. Generally, what we see is, on trending moves lower, like we can look at yesterday real quick, you'll see that behavior was lower all session. But you're probably thinking like, okay, cool, this is the end of the day. What did it look like in the middle of the day, and how is this tool actually useful? So I appreciate you asking that question. Here's what the tool looked like at 12:30 Eastern Standard Time today. There's a few important callouts. First, just look at the choppy nature of price itself. Second, look at the calls centroid. We can see on the day that this is generally flat. So there is no material call speculation moving higher. So this kind of puts a lid on the top of the market. So if you're a credit seller, as an example, and we're thinking right now, okay, price is not really showing or suggesting that it's going to push higher. Okay, cool. That could help inform a trade. And then second, on the put side, we can see that this has been ramping higher all day. So again, that makes you think, okay, why? If we're expecting price to go lower, why are put speculators not committing capital to the downside? So again, this kind of tells me I should be expecting kind of more two-way action again today, kind of a choppier in nature. And I should not be expecting, as of right now, a trending move in one direction or the other. And here I just want to quickly contrast that with yesterday. Yesterday, I mean, you should be able to see that this is just a completely different signature on the day. We had the call centroid and the put centroid trending lower all day. So in that case, it's like, okay, yes, it makes complete sense that we are having a trending move lower, both in terms of the intraday speculation, and then also when we connect that back to our market trend model, we can see that there is a significant waterfall move lower supported by large selling as well. So that's kind of how you connect the dots between the volume signature on the day, the market trend model, and then also, right, we were below all of our transition zones as well. So it's a mosaic approach, right? We have a couple key tools that we focus on. We're not a kitchen sink. We're not going to throw everything at you and tell you good luck. We really have a system dialed in to where there's just a couple of things that you need to understand. And that is, what is structure and sentiment on the day? What are my key levels? And then what are speculators actually doing intraday? And then this GIF that we create at the end of the day, where we're stitching all of those volume charts throughout the session, is really just useful to go back and look. We can see early in the session, we were trending higher on the day. And then it really starts to flatten out, especially that call centroid side, then eventually the put centroid side, and that's really where we get that two-way action. And so really, the key thing is we got that mashup push lower, but look how the centroids were both trending higher at that point in time. With that's all I got for you guys tonight. Really hoping that we can help you connect the dots between how we go from our pre-market process using just a few of those intraday tools to help us really understand what's happening in the 0DT complex, and either take advantage of the chop or help you stay away from the chop depending on your trading strategy. So with that, you guys have a great rest of your night. We'll see you all back here tomorrow. Thanks. Bye.